You're welcome. And if you're not, welcome back. Jeff, I wish I could just show you the way. But what I can do is just open up some interesting conversation. I could help you really, really be able to just take a different type of vantage point, a different look at the markets, and potentially help you make some really good decisions. That's what we're all about here. We're all about helping each other. Iron sharpens iron. It becomes this gigantic feedback loop. Like everyone keeps making these small incremental gains in knowledge and in ability, and it all just builds on each other. You look back over 6 months and you're like, wow, it felt like I was plateauing for a lot of that time. Look how far I come. You look back a year, forget about it. You look back 2 years or four. Is it five since we started? Unbelievable. All right, today's session, we're going to go ahead and do what we always do, take a look at markets, make sure we put the work in, and introduce some pretty new concepts today. What could be the silent strategy? Is it indeed the double speak? Are we looking at curve steepening by design? We're going to look at what's going on, check in what's going on with the US dollar, Japanese yen, whether or not potentially looking at risk on or risk off, and we're also going to be looking at the 10-year expectations, and then the trade, the number one opportunity of the year 2025. In the description below, I nested two things. I put in the tweet of the thread that is introducing this new macro concept, and pull it up somewhere over here, right over here. And then as well as I put in what else did I put into the nest? Um, anyway, let's go. Let's go. Tacos for everyone. So we got a lot of taco-ness going on over here. We got a major taco with no, I'm not even gonna mention it. I wanted to like we're gonna let go of that. We're gonna go in our happy place right now. We're gonna really focus in on the markets and make sure we walk away today just gaining a little more insight and growing in ability. Right now, we're looking at Trump saying today that I am not going to taco out, that on August 1st, there will be no change. This sounds like he's not extending it. I read between the lines, and yesterday we saw that a 25% tariff was imposed upon Japan. Obviously, Trump's been going after the automakers, trying to make American automakers really competitive. If I was in China, if I was President Z, I'd be like, "What do you're talking about? Like, how come we can't sell our EVs in America? What's going on? You're like that's a double stand. Anyway, whatever about all that nonsense. It seems that I caught news of Japan looking to go ahead, and Japan's not happy, but there you go. The US and Japan agreed to continue their talks on tariffs. So yesterday we had a 25% tariff levied on Japan, and then today they're agreeing to continue to talk. So we're going to have lots of moving goalposts until we get to some type of ultimate resolution. Is that the biggest thing overhanging the market right now? I've been watching this. It's all related. We're going to put all the pieces together, but ever since I'm going to call it the BBB, big back beautiful, build back better is now the big beautiful bill. Is it all the same thing? You have to wonder. But what I'm focused on here is now that the debt ceiling has been lifted massively once again, and until they reach it again, it's not a problem. Right now, the Treasury is out there, and they're refilling what's called the Treasury General Account. Right now, as they have been super accommodative during these debt ceiling negotiations, they were drawing down on that count. They went from about $800 billion down to about $300 billion, and that was accommodative for liquidity in the markets. But now they're doing the opposite. Now that the debt ceiling has been extended, they're out there and they're going to be in the market and they're going to be raising money in order to go ahead and what I presume will be to get back towards that $800 billion level. So it seems that the Treasury has about $500 billion of liquidity they need to take from the markets. The one thing is that there's only about 300 billion inside the reverse repo. So we will watch the reverse repo markets in the weeks and months ahead to see whether or not that's where this money's coming from. And if we see that drain down, it's going to be close to zero. All of that signals is that you are closer to any type of potential liquidity crisis. Now, liquidity crises, they're kind of like they come quick, they're very fearful, and ultimately the only way that they could be resolved is through a massive amount of injection of liquidity, and you see risk assets respond usually very, very quickly at it. That's when you get the V's out of those type of events. If something like that were to happen, that's going to be very bearish on purchasing power, and it's going to be very bullish on appreciation of risk assets. Now, that's just only one way that we, that a liquidity crisis again is almost like, well, that's kind of easy. A lot of you are all you were here in early 2020, the last time we had a, a liquidity crisis. I was just laughing at Deep Power. Not this is not the risk, but the really the risk of that is, guys, everyone knows that, like, they have that like phone, that spying device with them at all times, right? But your car is just also, it's just about the same today. The amount of information that your car collects from you is absolutely ridiculous. And when you plug your phone into the car, it downloads everything on the phone, and then, who knows what they do with that information. I surely don't, but I could say personally, not that I don't want the Chinese having that information. I could say that, even though their EVs look on the surface pretty and have cool tricks, but whatever. That's just, here we go. So we are all looking at, all of a sudden, all of that short-term paper being offered, and lickety split. We see, I was just trying to do math in my head really quick, but I would guess that's somewhere around 300 billion, a little shy, $280 billion on the short end. And then you got, this is long-term paper right now, 3 year, another 58 billion. And Trump said, I don't want anything, I don't want 10-year duration or anything like that right now issued, but nine to 10. Oh, it's 9 to 10 month. That's not even year. 9 year, 10 month. Well, come on now. That's just 10 years. That's just absolutely ridiculous. But there it is over here, and it's a very small amount in comparison to what they're looking to do on the short. And Jay Cora, thank you, my brother. Thank you, everyone, for being here. I just like love this time we spend here together. So we have to watch that stress out on the market. And I'm also watching, and this was actually brought up by Brandon, thrown out in the discretionary channel, eyes on to the next release, July 28th, at the end of this month, on the Treasury's quarterly refunding document. In the past, going back, I think, what was it, like July 2023, this was a big deal. A similar situation right after the debt ceiling was extended. We're going to see what I mean, listen, they tell us one thing all the time and do another. So we want to pay attention to what's happening, not what they say. But that's going to give the market a clue. That's something that the market will likely be paying attention to. We're still watching the data. As far as data, we got unemployment claims coming on Thursday. We got FOMC meeting minutes tomorrow, and just then looking ahead into the following week, we got some CPI information, which is very important. Obviously, markets paying close attention to inflation, and true inflation has continued ticking up here of the CPI, and like, watch oil. I'm watching oil. And also, Treasury Secretary Bessent said, listen, likely these tariffs are going to cause a one-off increase in price. As Powell has been saying, and Powell did say recently, over the next month or two, we should begin to see that reflected into the CPI. And if both of them are correct, that's likely why today we are seeing right now yields rising a little bit. And, I'm just looking at, are they rising in response to inflation and likely and probably, but more importantly, the coil continues, right? The coil continues. And we had that little bit of buy impulse on bonds, and then we had this sell impulse on bonds, and it's getting tighter and it continues. And we're watching indeed what is going to be the ultimate outcome, and it could go either way, right? If you like outside this pretty long consolidation here, if you break down, then bonds likely are going bid, right? And at the same time, and my own presumption is that we're going to break out to the upside here. And if you break out to the upside, it look, a lot of people have their eyes on 5% 10-year as being like like a really, the market likely could absorb 5% 10-year yields and likely will. The concern here is outside of a pattern like this, you could see a spike that could go actually a lot higher and a lot further than, yeah, I mean, I don't know about who the bond king is. That Jeffrey whatever, or anyway, both of them like anyway, we'll leave it there. But is 6% in the cards? You guys know that I said, well, you know what? I think a lot of people are calling for 5%. And I'm just going to find the video. I said I would not be surprised if we kicked up above 5.5%. And then like likely my own hypothesis is if that happens, that likely then is able to wash out a bunch of traders, and that could be ultimately a liquidity grab where we go down this way. Now, that would catch a lot of people off guard. It would probably hurt a lot of people, and it would probably flush out a lot of needed trades in the process. And what would be the ramifications? Why would this happen? What are they doing over here? Is this actually curve steepening by design? I hope you guys enjoyed the thread. Go, like if you have, I want you to go ahead as your homework today. In the description of the video is the link to this thread. Go ahead and read this thread, and then tomorrow we'll talk more about and any questions you have, include them on the thread as well, so that I know what kind of questions you have. There's a great question asked and answered over here. Look, does this come in the form of a crisis this year, causing downside in stocks and crypto? And there are two scenarios that could come from it, right? And number one is that we could see disorderly deleveraging, right? A mini credit event like forced asset sales, downside pressure to risk assets, including crypto. And ultimately, that type of situation requires a policy response. And that would be, listen, ultimately, everything is bullish for Bitcoin. Ultimately, is what happens in between that all the opportunity lies. And we want to make sure that we navigate, or we could have a deleveraging, maybe slow and painful and not a crisis. And in that case, then likely, I mean, do I think the continued bid we see in Bitcoin is going to able, even in that type of situation, able to allow Bitcoin to, why consolidating, right? Running sideways, chopping. Is it like, are we going to see any type of massive drawdown because of that? I don't think so. I think that Bitcoin is going to continue to hold up pretty well. Nevertheless, a slow motion deleveraging could get quite messy. We talked about what's happening in China the past 3 years. I think I would prefer the liquidity crisis if you ask me, but we'll talk more about it, and then we will. I mean, I wonder, honestly, I see stagflation, weakening dollar. I wonder, in light of the big beautiful bill being passed, if Jeffrey has any listen, all of us, when presented with new evidence, should always be out there to go ahead and change your mind in an instant. That's what it means to navigate the markets. And the thing is that, like, they're not looking for 3% growth to get this debt to GDP under control. They are looking for significantly higher growth. It remains to be seen whether or not they could pull it off. Expectations right now, again, for me personally, is that, well, we have right now the treasury refilling the TGA. That's bearish for liquidity. That's definitely bearish for liquidity. We look at seasonalities, and right now we're coming out of, or we're in the midst of the most favorable 2 week period of the year. It was right after the second quarter rebalancing when you saw a lot of institutions having to rebalance their bond and stock portfolio. We saw that there was $26 billion worth of stock sold. And then right after that, in the first 2 weeks, they go ahead and if they want to get back, we rebalanced on paper, but now, we have the ability to go ahead and buy, and the first 2 weeks of July have been very favorable over the last 30 years. And then after that, we kind of flatten out, and we know that August and September are actually the two worst months of the year for equities, for stock market. And it's usually coming out of that, and I'm just going to show you over here, like, if we make it through that area, it's, and we're still relatively close to levels we are today. Likely the end of the year is going to be pretty sweet and pretty nice. Now, we have a lot going on, and it seems to me that the market has responded very favorable to, right? You could see, like, we were ahead of like the last 2 weeks of June are usually not that good. And look, this is just seasonalities. It's just a guide of past behavior. It's not something that you position around, but it is something you consult. But what we had over here was that the taco happened once again. And we saw that, well, we're going to extend that out to August 1st, and the markets are like, we don't believe this guy. Ultimately, we think that this is going to be a nothing burger, and we're going to be able to continue up. That's not necessarily true. It's likely, but it's not necessarily true. And as we get closer into August 1st now deadline, is that going to become September? As we get close to the August 1st deadline, and if we see the market not respond well, it could be that type of summer into fall. So we'll continue to navigate it. Can you copy paste the link of the Gann chart to view? I don't know where you guys are going. Um, let's continue forward over here as we look at the 10-year, right? And I'm watching over here. I think likely this is responding right now uh uh off of dollar. I mean dollar, off of the upticks that we're seeing right now in inflation. By the way, you could see, let's check over here. All right, checking on my this was the whole Iran attack by Israel, and then the retest, and it found support on the retest, and is currently bouncing up over here. Watch, like, if we do see this scenario unfold where the US indeed just does try to grow its way out of it. And I have to point to you 1 second over here. This, like, so far, this deviation that's on the furthermost upside that we're trading above right now, this was the 1998 run, when you had, after 2 years of 20% plus gains on the S&P 500, there was a 20% pullback. And then coming out of it, it ran to the highest deviation into what is known as the dot-com bubble, right? And we're currently pretty close to that. We just went through 2 years of 20% plus gains back to back, had a 20% correction, and are now coming out of it on pace, outperforming, you know? And you're looking at the administration taking the forget austerity playbook. We're going with the growth playbook. And we got a lot of, like magic dust spread around there with the whole AI narrative. It's not a narrative. It's taking place. It's happening. And ultimately, my own belief is that, well, AI is gonna replace a lot of mid-level jobs initially, and that's going to be really good for these tech giants and their earnings. And then you're going to see, well, AI is probably going to make everybody a lot more efficient. everybody, people who learn to use these tools are going to be able to be much more efficient in what they produce and what they create. And it's not just a narrative, and there's real spending taking place. It's the reason that we see Nvidia right now right off its all-time high. um I don't know I don't know why I went over there. Oh, oil. Bringing it back to oil. And if indeed, we get into through the fall, and we have this, like, the run up really continues. We end the year at new equities making all-time highs. If that's all happening, I imagine oil's higher, right? And if that's happening, then you're going to see that pressure out on inflation. Puts the Fed is just in a really, really, really bad place. Brings me back to my thread. Perhaps it's the Treasury, that is, you guys, when, like, you've heard it before so many times, when the US says we have a strong dollar policy, that actually means they have a weak dollar. We've heard that this administration has been talking about wanting to get the 10-year down, and that's what they're focused in on, right? And here's what I think is really happening. Get into the thread, take a look at it, let me know what you see. We continue to see the dollar coming in for that retest on the breakdown, as a lot of people are looking for, these trade deals, or they don't really seem like deals. These like the result, I don't know what to call them. These trade imposins, watch over here. If we get back above, why everyone is short the dollar, we're going to have to flip back and be long dollar. But right now, that's a breakdown and a retest into play. This should and could easily resume down and further the weakening. We have to continue watching what takes place there on the dollar. And I think right now, this move right here, a lot of people are wondering, right? Rightfully so. Oh, I'm just glad I came back over here, because I'll come back to this in 1 second, right? That's I hope that's what yeah, I put this in the nest. That's the other thing I put in the nest. The video where I talk about the number one, the best opportunity for the next 6 to 12 months, and why it's on the 2 year. And we'll come back to that in a minute. But first, I want to go ahead and address this. And Aussie is like, friends, how about the most important chart in markets? Yen breaking out to the upside right now. It should be bullish for markets, right? I think of that meme. And, and anyway, maybe we could give an update on this right now. And right, right. So first of all, we saw. I've been watching this pattern that's developing, and I said if we break out, this is likely going to be very bullish for risk, and if we break down, that's likely going to be very bad. And I also said that there's a good chance that that could happen. We keep talking about August and into through September, the end of September, and that's the hold your breath type moment. And if we're breaking down, there's a good chance that that's going to be into September. You can see this little trend line I have, the one touch off of the bottom over here in January 2021. Interesting timing. That's when inflation began running really, really hot. If we break down from there, as you come into September, that I mean, we're gonna watch it, right? As you get through, actually, that would be in July, breaking down from that one touch and into the end of July. So we'll have to watch out for that. That is, yeah, that's a good idea. Sorry. So what's happening right now is we had that major wake up and then came back into neutral. So listen, after the wake up, though, the thing to do here is going to go ahead and you know do a one touch off of that. It's not only a one touch off of this, we found that resistance up over there, and you could see that we're coming and right into that resistance right now. I think this is more about the dollar right now and what's taking place, as the dollar here is going like that's not even, we can't say the dollar's bid. If we get back above here, we can say, well, it's an opportunity that we have a major buy up pulse coming into the market. But right now, the dollar off the breakdown is coming in for a retest. Come back over here and you look at what's going on with the US dollar, Japanese yen as it's making that retest. It's over here. But even still, you break out above there, this is now the one touch, right? So we got to get, to have a confirmed breakout that I would say this is now bullish for risk. We still got a ways to go, and I tried to get as early and close as possible with the underbelly over here, but it doesn't seem that that's what the market is paying attention to, and it seems that right now we're just into this area of resistance right now, and because of that, and that, will this wind up being the earliest breakout over here? It could be. I'm not buying it though. And then come back over here. And this is where ultimately we need to break out above to say that we are seeing the US dollar really moving against the yen. And that would be very conducive to risk. On the flip side, if we break down, this is likely meaning that we are into a major, major risk off move, and then that you might see something more like this occurring. Look at the yellow one over here. This is coming back to 1968, and in a major risk off move, we likely would see equities going down that way into the end of the year. That's why we're watching the US dollar, Japanese yen. My friend Sani has gone ahead and he just started this newsletter. He's been paying attention to the US dollar and Japanese yen and what it means ultimately for risk on, for risk off, whether or not we are in the process of a deleveraging event. If we are, by the way, if it winds up being a delever, and I don't know which way ultimately that this turns out. All I know how to do is have important levels in the market and then manage risk around that, right? And I don't know which way ultimately it's going to go. This ties in really, really quite nicely into this whole thread about whether or not they are indeed looking for to engineer some type of deleveraging event. So watch this, and we will continue to watch this. Let me throw this newsletter in here for those who want to read more about his thoughts um, on the U.S. dollar, Japanese yen, and what it means. And go ahead and subscribe to the newsletter as well for sure. Right now, it is available for free, and I think that it's a really good. Most people don't pay attention to the U.S. dollar, Japanese yen. They did during August of last summer when we saw the yen unwind, but most people don't really understand the ramifications of the carry trade and on the unwind and the ramifications it would have for markets. So I think this is a really good vantage point for you to go ahead and consider. Um, Run it back. Let's take what we haven't even gotten into our positioning. By the way, just a quick update. Silver is maintaining that $36. You would think, or I would think that we would be, let's check in on gold, right? Classic CTM over here in March of 2023, calling the gold super cycle. We said we're not going to stop at 25,000. I'll see you at 5,000. We've come a lot quicker than I expected and anticipated. What's going on right now? Let's dig in over here and come down to a small time frame. And what's interesting about this is we had this breakout, right? That breakout had one retest and then resumed up, second retest, lower high, another retest, crazy, back into that area of resistance, and now another retest. Guys, the same way we just looked at moving on the US dollar, the Japanese yen, you got to move this over here. And I want you to notice off of the top wick over here, that's we found resistance, but on this 2 hour time frame, we ticked up a little more. I'm just going to move it off of that top wick, and ultimately for this rally to continue, that's what we need to break out above. On along the same vein, right? You are coming in and you've touched this twice. A breakdown from over here that would send gold for a longer correction. I'd be all about it. Again, right now, the one bearish case for gold is the bearish case for gold. There's nothing bearish about what's taking place on gold, right? Copper mooning would suggest to me that we are about to move actually into a more favorable growth period. However, however, and if that favorable growth period is indeed on the horizon, if you look out into the markets 9 months to 12 months from now and we're much higher, right? At that particular point in time, that's the bearish case for gold. At that point, likely gold is continuing to consolidate. That this high, the high stands over here at 35,000. It's pretty neat that it hit the psychological level and then sold off 35,000. And the on the monthly, the RSI is so overbought, it's exactly what should be happening, right? So that it's not bearish for gold. That's it's almost like logical for gold. It would be great to see gold consolidate these gains, obviously running down and drawdown. I couldn't tell you, where it would ultimately bottom out. I would love to see gold testing back towards 3,000 and maybe a little bit below it. You could see over here this resistance flipped into support. We want to see that hold. We don't want to see that area break anywhere around here, right around the psychological number. I think that would be a really good and strong point to look at it. But ultimately, when gold eventually takes out where the RSI peaked, where price peaked on that overbought RSI, likely that is going to be the confirmation of when the next leg up for gold is coming, and likely it's going to take out 3,500 and really, really make some gains at that point. But I think right now, if we indeed we do, and that could right, if we get a breakout over here, and this breakout actually has legs, maybe right now and through the summer, we're not looking at growth. Maybe we're going into a little bit of bumpiness, right? And if that's happening, then you're going to see likely gold able to continue over here and challenge the top of the range. What will spark crypto's next move? Sailor, I believe, is setting up Bitcoin continuing to look really good over here. A lot of eyes on Ethereum. We're holding Ethereum long right now. If you jump over and you go into the dashboard, you could see Dogged Nations little vibe coding over here to the dashboard. And Ethereum's currently in that long trade right now at break even. Bitcoin just exited its 107, right? Like a 0.3 percent loss. Didn't like that. There was no follow through on the momentum. And hey, a lot of people ask me, "Hey, Jordan, what is CTM? Is it like short-term day trading? Is it swing trading, position trading?" And actually what it is like our losers are short-term trades. We get rid of them quickly, right? Most of the trades are swing trades. Trades that go in our direction are swing trades, and a small minority turn into position trades, and those position trades make up the majority of our gains. Ethereum over here right now holding, right? Right at break even, you know, 0.6% into profit. And a lot of people, I saw someone post in the Discord out in Times Square. The NASDAQ has this big billboard and it's like all eyes on Ethereum. Seems to be a lot of interest. Does anyone know that Penguin account on Twitter, on X? The Penguin, he just brought up Ethereum. It's been I can't probably the last time he brought up Ethereum was back into 2020. So a lot of people looking at Ethereum right now, including um what's his name? Who's the guy that's always bullish? So he's only wrong one time a year. Um Anyway, you guys know him. He's always on CNBC. He's talking about building a Ethereum treasury company, and we talked about, listen, that could put a strong bid into Ethereum if people actually start raising money inside the public markets and stacking Ethereum. There it is, the Pentashi. Pentashi. I don't have an opinion on Sui. Um, I don't have an opinion on Sui. We focus in on really obviously on Bitcoin, uh Ethereum, Cardano, and Solana. Um when it's alt season, this is not alt season. When it's alt season, we'll take a deeper look at where we should be potentially speculating. Bitcoin bull runs over here continues to be long. And if you look at our positioning, right, across stocks are on the daily time frame, but same situation right over here where you see that the longer you hold, turn those swing trades into position trades. TQQQ currently at 24%, 25%, Nvidia at 12%. The new trade on the spot ETFs minus 7%, and FNGU holding a hard one here. It's got that big stop, 7%. FNGU is our best performing template. Currently minus 2.6% against us. And Microstrategy coming out of the fractal is holding a trade right now minus 6% into profit. It's that riot fractal over here, right? And you've seen Bitcoin do this in 2012 and right now on the launch pad, right? And you can see MicroStrategy right now breaking out of it. Let me go and show you a MicroStrategy so you get a good look over here. So it's that same fractal on Riot, right? And you can see that move up, the lower low, the move up into the launch pad, and right now MicroStrategy trying to make the move out of the launch pad. Bum bum bum. All right, everyone. Tom Lee. Tom Lee. Tom Lee. Oh yeah. So, all right, everyone. Make sure you go right now into the description, check that X thread, absorb it, ask any questions we want to get into. And either way, I'll be unraveling it in the days and weeks ahead. Oh, we wanted to check on the 2-year. That's what I want to do right now. And then also check out that video in the nest on the 2-year as well. Let's jump over here. Let me come over and we're on Riot. I don't want to get off Riot. So let me go ahead and see what else I could bring up. Here's NVIDIA, right? Oh, by the way, on NVIDIA, we just made that low over there. I wonder if we should keep stepping up over here and just watch them as NVIDIA here continues consolidating, peaking into all-time highs. Thank you, Jen. Thank you. Let's check in on ZT. And let me start over here with this chart of the 2-year. So right now, we're looking at, and just to give you a quick summary, watch the video. It's not a long video. It's very, very important video, very good video. But the premise of the trade here, and I get into the leverage involved in the futures market and why a move down from here to 2%, you know, has a massive, massive risk to reward. But there's risk involved, right? And the risk that I see, and the premise of the trade is that right now, you know, does not look like Powell's cutting in September. Uh, you know, a lot of people calling for, some people are calling for a surprise 50 basis points cut coming in July. It doesn't look like that, the Fed is, hold on one second. Let me just show you the expectations over here. So into July right now, we're looking at currently, let me refresh CME. So 95% chance that the Fed is on hold. I've seen calls for surprise 50 basis points cut. I don't think so. Moving into July right now, and all right, there's a decent chance for sure. 35% chance they hold, 34% chance they hold. And, that's something we'll keep an eye on. September is definitely up in the air at this point. Right now, markets are signaling a 25 basis points coming in September, or at least a greater than 50% chance of that. So obviously, next week we have CPI data. We're likely going to see, between what Powell has said, between what Bessent has said, and between what we see going on over here with true inflation, that we could see higher upticks in inflation. And if that's happening, there's a really good chance if the job market maintains that holding in there above 100, then we're going to see September priced out. And if that's all happening, right, then potentially here we could continue to see the 2 year continuing to rise up. Now I have this area over here, right? I would love the opportunity to get a touch close to that, you know? Then we go ahead and just bring down over here, and here's our underbelly. You could see that there's the resistance, there's the support, broke down, breakdown, retest, resumption, and there's the resistance again. A move into this area also, that becomes quite attractive from a risk to reward standpoint, right? That would be the place that I look to put on the trade myself. I think that, you know what, there's a chance that we could even come up into here. And then, of course, you just got to reduce risk. You know, you got to is a good place to manage risk for me to get out of the trade if you were to break above that line, close above that line, and then just reevaluate when you could reposition. But whether or not Powell cuts rates at all this year, and you could just see the, like I made the case of why we're not getting a cut even in September, right? That's likely going to get priced out. Then, you know, if you see a little bit higher upticks in inflation, could we see the 2 year rise here? My concern is, and there's so much demand for short-term treasuries, right? Domestic demand, foreign demand, that likely it all the new issuances will be absorbed. But because of the amount of new issuances that have to come into market, my only um fear is that the pressure actually cause the 2 year to rise a little bit ahead of time. And that's why I put a 6 to 12-month time frame on this, because ultimately Powell's term is up. He's not being his job term is not being extended by Trump, and Trump is looking to put someone into the spot that is going to begin cutting the Fed funds rate. And as the Fed funds rate gets cut, you're going to see the 2 year come down. So that is a pretty strong update to what's going on with the 2 year. And that's exactly what's happening. Fed meeting minutes tomorrow. Everyone, sweet. Do hit the thumbs up on your way out. If you want to introduce someone to the community, just take a moment and share the video with them. Everyone, have a beautiful day. God bless you. And I'll see you all on the inside.